Higher mortgage rates continue to impact demand from potential home buyers. The CEO of one of the nation's largest home builders joins us right now. Sheryl Palmer is Taylor Morrison's chairman and CEO. And Sheryl, thanks for coming in today.
It's great to see you. Thanks for having me.
Let's talk a little bit about how things are going, because we saw interest rates start to come down and then rise back up. What does that mortgage rate mean for the buyers? What does it mean for the builders?
Yeah, you're right. It's been a little bumpy over the last, 12, 18 months. And in the fourth quarter, we saw rates drop back into the sixes.
Yeah.
And what was so nice about that, Becky, is the consumer's actually in a very different place than they were a year ago, 18 months ago, where they thought rates were going to, be back into the threes or maybe low fours. So the consumers kind of met us halfway. So when they dropped into the sixes, we had the ability with all of our tools to get them comfortably into 5% interest rates. And I think the consumer recognizes, by any long-term historic standard, that's a really good thing. Today, they've moved back up. I mean, the 10 years, at 4.3? Yeah. Rates have moved into the low sevens. Interesting, we just reported our earnings, and last quarter, the average coupon of all of our closings rate was like 6.7%. So it really tells you how far the customer and the consumers come. But once again, we have the tools to get them into the low fives, the mid fives, really personalize a rate based on what their needs are.
What tools do you use, and what does that mean for your profitability?
Yeah, it's a number of different tools, and I think not painting all customers with one brush is probably the most important part of that. Some customers need a little bit of help with cash at closing. Some want the confidence of a 30-year fixed rate, and so we'll do forward commitments. Some need a temporary support, so they might do a 2-1 or 3-2-1 buy down. That 6.7 would be the final coupon rate, but it tells you what they expect to have happen. The cost of when we first started doing this a couple years ago was actually much more significant, because we were trying to go from the sevens down to 3.99 or 4.25. Today, when we're looking at 5.5, 5 and 5.75, it's just not as bad.
Meaning customers are thinking, okay, 5.5 sounds pretty great to me right now.
That's right.
Versus 2 years ago, that was sticker shock.
As silly as it is, they went to 8 so quick that I think it kind of reset the customer's mind so that they don't expect that they're going back to 3.99.
Sure, every time Diana looks on, she says, yeah, it's not a demand problem.
It's not a demand problem.
So why aren't you building more? Why aren't home builders matching in? If you can sell, why don't you match the demand? Why can't inventory match the demand? It takes time, or?
Well, we have, if you look at the new home inventory across the country today, I would tell you it's a really healthy, probably 7 months of supply. The real important detail there, Joe, is what is the finished inventory, and that's relatively low. So I think that's actually a really nice balance, because I think we're like 1.4, 1.5 months of finished inventory. I want to have inventory at all stages of the production cycle, and we do. The resale inventory is also pretty tight, and that's the lockup effect you keep hearing about. I think we just moved to about 3 months, but the devil's always in the detail.
How's land? Do you buy big plots of land? I can remember in years past, Lennar, somebody got in trouble. They had spent so much money, and then the land prices dropped, and they were stuck with it and had to write down. But how do you do that? Do you buy a huge swath of land to put up a development?
We do. We're a developer first.
Is it based on mortgage rates too, or?
Well, when you underwrite the land, recognize land I'm buying today is not coming to market for 2 to 3 years. So it's really the land that I bought, back in 21, 22. When I look at Taylor Morrison, we still have just under 50% of our land that's purchased pre-COVID. So it's actually from what it's sitting on our balance sheet, it's in a really good place. But yeah, we buy parcels. Our average is probably 150 lots, Joe. But we'll do, we build for all segments. So when I think about our active lifestyle communities, those could be 500, 1,000 units, golf courses, lakes, big amenity packages.
But to put all of those loans, interest rates have gone up, so it means you have to pay more for every one of these purchases you make, for every one of the builds you do. What's the limiting factor right now? Is it, it's too expensive to build the homes? Is it too hard to find people to build them? Like what would be the limiting factor when you look at this?
So I guess a couple things there. One, all consumers aren't created equally. So when I think about the support that we need to give to that first-time buyer, they may not have the equity in the house that a move-up or a 50-plus, lifestyle buyer has. So most of our incentives back here are going to really support that first-time buyer. You look at the average equity that's out there today, and I think I just read something that said, if you've owned your home about 4 years, and you bought a medium-priced home about 4 years ago, you have over $200,000 in equity. So they have, if you bought it in 2000, you might have over 400,000 on average. So they have other levers to pull. As far as the labor environment, I'm not going to say we're back to pre-COVID, but we are much better placed than we were these last 18 months where the entire supply chain was really challenged, and labor. Today, I think, honestly, it's very predictable, dependable. There's always going to be something, but it's not everything any longer.